International families often hold assets across several jurisdictions. A bank account may be in Hong Kong, property may be in the UK and Dubai, company shares in another jurisdiction, and investment portfolios booked through Singapore, Switzerland, or any other financial center. This may work during your lifetime, but succession and control can become more sensitive when assets are held personally. If something happens to the main wealth holder, access to assets may depend on the probate, court recognition, banking procedures, and law of each jurisdiction where assets are located. A Hong Kong trust can help bring structure around these assets by allowing legal ownership to sit with the trustee, while the economic benefits are preserved for the beneficiaries under a clear trust deed. My name is Shiraz Waheed and I'm the co-founder at Lepidus Wealth. In this video, I'm going to explain how to set up a trust in Hong Kong, what are the main parties involved, what documents are usually required, and how assets are transferred into the trust, as well as where tax and succession planning needs attention and how it can work alongside wider structures such as SPV, family offices, and offshore holding companies. The aim is to understand the process clearly before the structure is created. With trust, the setup is only one part of the work. The more important part is whether the structure is designed properly for your assets, your family, and the jurisdictions involved. So a trust in Hong Kong is an arrangement where one party, called the trustee, holds assets for the benefit of other people, called the beneficiaries. The person who creates the trust and transfer assets into it is usually called the settlor. In practical terms, the settlor gives legal ownership of the trust assets to the trustee, and the trustee manages those assets according to the trust deed. This is different from simply opening a company or holding accounts. A company is a legal entity. A trust is a fiduciary relationship, which means that the trustee has duties and must act in line with the trust deed and applicable law. Hong Kong is a common law jurisdiction, so trust concepts are well recognized and commonly used for private wealth, succession planning, family governance, investment holding, and business continuity. For international families, the attraction is usually control and continuity. A properly created trust can help separate personal ownership from family wealth, reduce reliance on probate for trust assets, and create a structured way for the next generation to benefit. But a trust does not automatically solve every tax, inheritance, or asset protection issue. The results depends on how it is created, when it was created, and where the people involved are resident, as well as where assets are located. Now, before the trust is created, the purpose of creating that trust should be clear. Some families create a Hong Kong trust for succession, so shares, portfolios, or family assets can continue under one structure instead of passing through multiple probate processes. Others use it for governance, especially where a founder wants rules around distribution, family involvement, and control if the founder is no longer active. A trust may also be used for asset holding. This can include investment portfolios, company shares, insurance policies, and private family assets. There may also be tax planning elements, but this needs careful advice. Hong Kong does not currently impose estate duty for deaths occurring after 11th of February 2006. But that does not mean a Hong Kong trust remove tax exposure in every other jurisdiction. UK inheritance tax, US estate tax, Indian tax rules, European succession laws, and local reporting obligations may still matter depending on the family profile. So when it comes to the purpose of the trust, are you using it for protecting control of a family business? Are you planning for children in different countries? Are you coordinating trust ownership with companies or other holding entities? A trust created without a clear purpose can become difficult to manage. A trust created with a clear purpose can become a practical control layer around the family wealth. Now, once the purpose is clear, the next step is choosing the type of Hong Kong trust. For private wealth planning, families often consider a discretionary trust. In a discretionary trust, the beneficiaries are identified, but the trustee has discretion over how and when distributions are made, subject to the trust deed. This can be useful when the family wants flexibility. Children may live in different countries, have different needs, or become tax resident in a different jurisdiction over time. A discretionary structure allows decisions to be made based on the circumstances at the time rather than locking everything into a fixed percentage from the start. Another option is a fixed interest trust. In this structure, beneficiaries have defined rights. For example, one beneficiary may be entitled to the income while another may be entitled to capital later. This can provide certainty, but it may be less flexible. Some families also consider reserved powers, where the settlor retains certain powers such as investment direction or appointment of the trustee. This must be designed carefully because retaining too much control may create tax, legal, or asset protection issues in some jurisdictions. After the trust type is selected, the trustee becomes one of the most important decisions. The trustee is the legal owner of the trust assets. The role carries responsibility. The trustee must administer the trust, follow the trust deeds, keep records, deal with the banks and investment managers, as well as consider beneficiary interest and manage the structure in accordance with the law. In Hong Kong, professional trust service providers are generally expected to comply with licensing and anti-money laundering laundering requirements where applicable. This matters because banks, investment platforms, and counterparties will usually look closely at who the trustee is. A professional trustee can provide continuity, experience, administration, and institutional governance, especially where significant assets are involved. Some families may consider using a private trust company, often called a PTC. A PTC is a company created to act as trustee for one family or connected group of family trusts. This can allow more family involvement in the trustee level decisions while still creating a formal governance structure. This can be useful for larger family offices or families with operating businesses, but it also adds cost and administration. Now, once the trustee is chosen, the main legal document is the trust deed. The trust deed sets out the rules of the trust. It defines the settlor, the trustee, beneficiaries, the trust assets, the trustee powers, distribution rules, investment powers, and the appointment and removal provisions, as well as governing laws and administrative procedures. The document should be drafted carefully. Small wording choices can create large consequences later. The definition of beneficiaries may affect tax analysis. Trustee removal powers may affect control, and investment powers may affect how portfolios can be managed. Alongside the trust deed, many families prepare a letter of wishes. This is usually not legally binding in the same way as the trust deed, but it gives guidance to the trustee. It may explain how the settlor would like the trustee to consider education costs, medical needs, family business involvement, lifestyle support, philanthropy, or future generations. The trust deed creates legal framework. The letter of wishes gives practical guidance. Now, after the documents are prepared, the trust must be settled. This means the settlor formally creates the trust and transfers initial assets to the trustee. The first transfer may be a normal amount, followed by larger transfers once banking, investment accounts, or asset holding arrangements are ready. The asset transfer stage is where many structures become more complex. Moving cash is usually simpler than moving shares, real estate, private company interest, insurance policies, or operating business assets. If the trust will hold company shares, you may need share transfer documents, company approvals, and possibly valuation support. If the trust will hold investment portfolios, the trustee may need to open accounts with a bank or investment platform. And if the trust will hold real estate, local property law and stamp duty must be reviewed. The trust deed alone does not move the asset. The legal transfer must be completed properly, otherwise the trust may exist on paper without achieving the intended results. Now, before significant assets are transferred, tax and reporting must be reviewed. Hong Kong tax is generally territorial, but the tax position of a trust depends on the nature of the income, the trustee, the assets, and the beneficiaries, as well as jurisdictions involved. For a family with UK connections, inheritance tax and domicile can be important. For US person, estate tax, gift tax, income tax, and reporting rules may need review. For Indian, European, Middle Eastern, or Asian families, local tax residency and anti-avoidance rules may also apply. A trust may be useful for estate planning, but it must also be coordinated with the personal tax profile for the settlor and beneficiaries. If the settlor retains too much control, some countries may still treat assets as connected to the settlor. If beneficiaries are resident in high tax jurisdictions, distribution may create local tax consequences. Banks and trustees may also need information for CRS, FATCA, beneficial ownership, and anti-money laundering checks and source of wealth documentation. Once the legal and tax points are reviewed, the structure should be designed for governance. Governance means how decisions are made, who has authority, how the information is reported, and what happens if key people are no longer available. In a Hong Kong trust, governance may involve the trustee, protector, investment advisors, private trust company, or a family office. A protector may be appointed to provide oversight. The protector may have powers such as approving trustee changes, consenting to major distribution, or reviewing important decisions. The role should be drafted carefully because protector powers can affect control and tax analysis. For families with operating businesses, governance is especially important. The trust may hold shares, but the business still needs clear management. Shareholder rights, board appointments, dividend policies, and family employment rules should be aligned with the trust structures. For investment assets, governance may include an investment policy statement covering risk limits, liquidity needs, asset allocation, and reporting expectation. Now, the next practical step is administration. A trust normally needs records, trustee resolutions, asset statements, tax filings, beneficiary information, and banking documents. Professional trustees usually have a formal onboarding process. Banks may ask for a trust deed, identification documents, source of wealth evidence, details of settlors, beneficiaries, protectors, and controlling person. This can take time, especially where assets or family members are spread across several countries. The family should also decide how reporting will work. Some families want annual trust accounts, other needs consolidated reporting across trusts, holding companies, bank accounts, and investment portfolios. This is where family office or central advisory team can add value. The structure may be in Hong Kong, but the reporting may need to connect with families' wider international assets. Now, Hong Kong Trust should not be viewed in isolation. If you still hold assets personally, you may still need a will. If assets are held through companies or SPVs, the ownership chain must be reviewed. If there are existing succession plans, shareholder agreements, insurance policies, or family office arrangements, these should be coordinated with the trust. Now, once the trust is set up, the trust should be reviewed regularly. A trust may be intended to last for many years, but family circumstances change. Beneficiaries relocate, tax laws changes, assets are sold, new businesses are created, marriages, divorce, death, and incapacity can all affect how the structure works. The trustee should keep proper records and review the structure periodically with legal and tax advisors. The letter of wishes may also need updating after a major family or business event. A Hong Kong trust can be a useful structure for international families, but it must be designed and maintained properly. The value for such structure comes from legal clarity and the cross-border coordination. So if you want our help and would like to explore if a Hong Kong trust structure can fit your situation or any other international trust, foundation, or holding structure, you can request a personalized asset protection plan by clicking the link in the description below. That's it for today, and I will see you in the next video.